time to fuel your business success. Welcome to Harmonious at Lunch. We're bringing you bite-sized advice and expert conversations to drive clarity and growth 5 days a week. Make sure you join our Facebook group at humanop.com/lunch, where listeners like you and our guests hang out so we can find harmony in business together. If you're building a business, you're in the right place. Let's dive in.
Welcome back in to some more bite-sized business advice. In today's episode, we're talking about cash. That's right, everybody's favorite or least favorite topic, I guess, depending on how you feel about your cash flow in your business. We're going to talk about how to understand it and the steps to maybe get more of it or find out where it's leaking in your business. I got Cash Flow Mike with me. Welcome to the show, Cash Flow Mike.
Brandon, live from San Antonio is Cash Flow Mike. Here we go, right?
I love it. I love the energy. It even says money isn't energy. Mike isn't energy is what it really should say. That's what I feel about this episode so far.
Hey, you know about money, right? I mean, you have to attract it. You can't chase it, right? That's what
right.
makes it an energy. And it's an energy because it just flows through you. It's either positive or negative, depending on how you feel about money at that point in time.
Yeah, which already we're talking about a different lens on money than most people in your industry probably do. So why don't we just start there before we talk about understanding it in your business? I love the analogy, and I heard this from somebody else too. It's like a fish, right? If you chase a fish or an animal, it's going to run away from you. So if you chase money, it's probably going to run away from you. Unpack that for me, the whole money is an energy thing and how you view it in business.
Yeah, I think you've probably heard it or seen it, or even if you've talked to somebody, if you've ever been on a sales call where you were the customer, you can almost smell desperation on someone. Right? Like,
yeah.
They're working way too hard for this, or they're sending me too many emails. They're just a little, I guess my teenagers would say, extra, right? So, it's one of those things where you just can't chase it, right? You have to be able to draw it to you, and you do that with a combination of two different things in my world, which is we call it a value proposition, but in simple terms, that is, what is the promise you deliver, and why should I get it from you? If you can answer those two questions, generally you can attract money.
I love it. So with that in mind, we've talked about being clear about that stuff on this show before with past guests. So I don't want to necessarily go down that road, but it's very, very important. We can't overstate it. So I'll say that and then say, now we're going to move on to something else. So when you're looking at money in your business, even though we're not chasing it, if we have the right energy towards it, it may leak every now and then. It may leak out of the bucket that we call our business. So we need to understand how to manage it best and how not to be dumb. You put that in the topic for this episode. Don't be a dumb business owner, which I love. So what do you come across on a day-to-day basis that has you putting that in for the potential title for this episode? There's got to be some stories.
Well, I mean, the first story is me, right? I mean, I built 14 companies, and dumb doesn't mean unintelligent. It means I don't understand my business, right? That's what dumb means.
Like that.
Yeah, and that was me sitting at the kitchen table. I had a hotel staffing company. I had 27 offices, about 200 people working on a daily basis across 9 states. And I'm sitting there, and I just can't figure it out. I'm like going, why can't I figure this out? I'm making money. I can see the reports. I'm paying taxes on it. How come I don't have any?
Always a good question.
Yeah, it's just like when I'm sitting at the kitchen table, I'm like going, I'm not dumb. I just don't understand my business. And you know how something kind of clicks? You're like going, oh, that actually fits.
Oh, look, I am dumb.
Yeah, and what I learned in that moment was that money moves 2 different ways in your company at all times. We tend to just look at it one way and not the other, or vice versa. But you have to look at it going in both directions at the same time. Here's what I mean by that. Money moves vertically through a company. I call it cash generating activities. When it starts with sales, and we keep subtracting out cost until we get to profit, right? That means you're making money. And that's why I said, hey, I'm making money. But why don't I have any? It's because it's the other side. It's the horizontal movement of money through your company, which is how long it takes to get to you, right? Even though I made the sale, I may have given it to, we'll say Marriott at the time, on an invoice, and that invoice sat on somebody's desk for a certain number of days before I got paid. In my case, it was almost 90 days. So think about all the payroll that was going out every 2 weeks for 200 people, week after week, month after month. There's 6 payrolls in 90 days that I had to have the money up front for before I got paid for the first invoice from the first month. It's just like a crazy amount of money was going out. So I never felt like I had any because I hadn't figured out the concept of the financial gap yet. And the financial gap is the difference between money coming in and money going out. And your working capital, which I call money you have, is designed to cover that amount of time. That's how much working capital you need to have. A lot of people know how much they have. They don't know how much they need. So I teach them how to figure that out.
So let's unpack that a little bit, because that's
a lot.
Yeah, it's a lot. Let's
Yeah.
just go unpack. No, I'm just kidding. But that's something that's common in a lot of businesses. And while 90 days is a lot in a lot of industries, it's still a real thing, even if it's 30 days. There's a lot of businesses who just see money come in on an invoice and think that's money to spend, not realizing that, money in the bank is a totally different story. And if that 30 days gets pushed to 45, 60, 90, like you said, you could be in a world of hurt because you got to make payroll. So understanding what you have and how to manage it, where do you start with people on that by identifying what do you really need to have on hand?
Yeah. All right. So, I mean, if I'm just going to give a client a rule of thumb, right? Just meaning we're not going to do a lot of math. We're just going to say, hey, let's try to get to this point if we're not already there. Whatever you're spending on a monthly basis, let's call it $10,000 on your rent, on your utilities, on your software subscriptions, those type of things. You should have 3 to 6 months just kind of setting aside. That's kind of the first baseline I try to get people to is, hey, 3 to 6 months of your operating expense. And the reason why I say that is things happen. It could be a hurricane, a tornado, COVID. I mean, 3 to 6 months gives you time to figure out the next step, the next option, right? So some people use the calculation days cash on hand, if you've ever heard of that. I like to call that days to bankruptcy, right? Because it assumes no sales, low or no sales, right? And that's not how most businesses work, where I don't have any sales coming in. But if you look at days cash on hand, I mean, you should have 45 days or more, but it's still days to bankruptcy because it assumes that I'm closed down or I'm close to closing down during that time. So that's kind of the basis point, right? How much do we have and how much should we have? Then beyond that, I do look at a thing called the financial gap calculation. And that is how much money you have sitting on the shelf in the form of inventory. So how long does it sit there? How long does it take me to collect from my invoices? And that's the money in time. So imagine, I'm going to do a math. And I mean, people love doing math on podcasts, right?
Yeah, who doesn't, right?
Yeah. So, but we'll just say it's 90 days worth of inventory, which means it's on average sitting there about 90 days. Then let's just say it takes 30 days to collect your invoice. Well, that means money has been sitting dead, already spent for 90 plus 30, 120 days. And let's imagine you at the same time, you're paying your bills, right? While you're waiting to get paid, you're paying your bills, and you're paying your bills in 60 days. So if I'm paying my bills in 60 days, I take the 120 and subtract out the 60. That means I need to have enough money to cover 60 days worth of expenses. And that's kind of the basics of how I start to optimize cash. Because that 60 days, how many payrolls do I have to make? Or that 60 days, how much inventory do I have to buy to keep up with my sales? So that's kind of the calculations that we figure out to determine how much you need in your business.
The 60 days is the total, or do you add that on top of the days to bankruptcy calculation?
No, they're two separate, right? The calculation I just gave you, the financial gap calculation, assumes that you're in business. You have a business that's ongoing. It's working every day. It's a normal business. They're two separate calculations. So the one I've just told you is about the financial gap. And the whole thing about a gap, if you think about the financial gap, you want that number to be small, right? Think about jumping over a hole in the sidewalk, right? And the smaller it is, the easier it is to jump over. It's the same thing in your business. The smaller the financial gap, the less money it takes to run your business. So if your business has ever felt clunky, like, oh, I'm always waiting for money to come in before I can do something else, it's because that gap has gotten too large and you have to take steps to make it smaller. Less inventory, collect faster, pay slower, right?
Absolutely. I don't know why just this image of on a CEO's dashboard or something, the days to bankruptcy, like in big red letters. That's just, it seems like a very visceral report that you'd have to look at on a daily basis. So maybe don't do that, but very good calculation to have. Don't get me wrong. So when I've consulted with a number of businesses and they can't answer those questions when we first start working with them. I feel like it's common for a lot of business owners, and I'm talking 7, 8, 9 figure businesses.
Mhm.
When you're working with people or in stories that you've heard, is that common, first of all? And what are the first things to go do and find on your financial statements to start putting these metrics into place?
Yeah, a couple different things, right? So it is common, right? Very common because people get involved in their business, right? There's 1,000 things they do on a weekly basis because they're just doing it. And you've probably heard the thing, working in your business versus on your business, but nobody
Yep.
ever really tells you what that is, right? So I built a cause and effect chart where here are the things that you're doing that work in your business. Here's the things you should be doing to work on your business, right? It's kind of a cause and effect because I was trying to predict the future. What I try to, get people to do up front is to understand what their burning issue is. That's the terminology in my course, burning issue. And you do that through a series of questions like, hey, what's going on in your world? Or, tell me more about that. Or, just I'm getting them to say what they feel the problem is because if you've consulted businesses, I can hand you a set of financial statements and you can find probably 10 problems. The thing is, they're not problems unless the client feels it. Right.
That
You
is
know,
true.
Meaning that, I want to solve the pain that you feel, not necessarily the pain that I see is kind of my philosophy. So if I want to talk about the future and you don't know if you're going to make payroll, well, those are two opposite and competing thoughts. I have to talk about the payroll. I can't talk about my stuff first. So what I try to do is say, okay, what is it? And generally, if it's about money, there's one of two problems that are happening. One is a profitability problem. The other is a cash flow problem. And they're separate problems. One is about the business model, and that's the vertical way that money moves through your company. The other is a conversion problem, how long it takes to do this, right? That's the cash flow is a timing issue. So I use a cash leak map to figure that out. And it's 6 calculations on one visual that shows me in a bar chart where the money is leaking out and if it's a profit problem or if it's a timing problem.
I feel like charts, graphs, spreadsheets are my love language, and I really want to dive deeper into that. Is all of this stuff in that course that you mentioned?
Yeah, it's in
And
the
is
course.
that the one that you're giving to listeners?
Yeah, all the the course that I'm giving to listeners is just a spreadsheet. The one I'm going to give to your listeners is it's called the 7-minute conversation. It's kind of the one thing that got me known across the nation. It's how to analyze financial statements in 7 minutes or less. In the course, I call it the home run financial system. Right. And the reason why I call it that is because it touches all the bases, right? The income statement, the balance sheet, and the cash flow statement. We tend to lean on one versus the other all the time. This one hits all three in 6 calculations and kind of gives you the biggest problems in your business. Right. It'll highlight those.
I like it. Okay, cool. So I put that on the screen, cashflowmike.com. It's down below in the show notes. But to understand this as a business owner, again, the inverse on conversation, that's a lot to unpack. But a lot of business owners, like you said, if they don't feel the problem, they don't know it's there and they're not digging deeper to figure it out. I had a client who I remember multiple 7-figure business, been in business for a number of years, a generational business, as a matter of fact, and got themselves to the point where they were mountains in debt. And I mean, like, to the point where there's no way they could ever service these loans. But they kept thinking, oh, there's money coming in the door and I have clients, so I can just keep taking out loans to buy more things.
Mm-hmm.
Instead of going down that path, how do people, like, before you take on debt, what do you need business owners to really, really understand before they have that conversation of, do I want to grow my business and do I want to take on debt?
Well, I mean, first of all, you've got to understand your own business model, right? Does it even work? Meaning, if I can buy labor, materials, whatever it is you're selling, it's either service or goods at a certain level, what do I have to price it at to make enough gross profit? And if I can give you one piece of advice today, gross profit is the most important number in a business. It is the only place to get cash to spend on your expenses or put in your pocket. You can't spend sales. Sales is only a measurement of how much work you did. You can only spend gross profit. Right. So kind of remember that. People think, oh, I'm at $1 million in sales. Doesn't mean anything if you're losing money on gross profit. Right. That just means you're digging a bigger hole every time you sell something.
Yeah, absolutely. And these are different calculations than banks and lending agencies will run. Am I right? Because this person still, for some odd reason, qualified for lending, but they didn't understand that that was just putting them in a deeper hole. So from your own perspective, is there due diligence that you should do on your end, another example comes to mind. Actually, the person that bought a business from me in the past, they didn't understand that the amount of their loan on a monthly basis was going to be more than our gross profit on a monthly basis. And they also didn't want to be involved with the business. A plus B equals that's a dumb decision, but they went ahead and made it anyway because the bank said yes. So without listening to banks, what's your advice there before? And it could be loans, it could be debt, it could just be scaling your business and putting money into Facebook ads. Like what's the calculation that we need to make there as business owners?
Well, first of all, you probably don't know my background, but I teach at the Graduate School of Banking at the University of Colorado, and I've taught at LSU and University of Washington as well. And bankers in general, you have to remember this first. They're salespeople, right? They're selling you a loan, right? Because that's how the bank makes money. Now, my hope is that they're not making decisions that put somebody in a bad position. So there was probably more to it than what you just described, which means he had a personal guarantee, he had personal finances, he had X number of cash. That way that didn't matter. And maybe he had a business plan to change the gross profit, right? Or something. But so I'm thinking there's more there. But the thing that I want people to understand is that I'll just give you one quick calculation, 2 things that you should look at. If you've ever heard of EBITDA, which I think you and your clients have, or your listeners have, EBITDA times 3 is about the max they'll give you on long-term debt. Right now, it's a change. It changes a little bit across the country depending on the chief credit officer and his secret sauce. But
Real
in
quick,
general,
how is long-term defined?
Long-term is like I can't pay it off this year, right? Or I shouldn't be paying it off this year. And I'll give you another rule. The length of the loan should match the life of the asset. So long-term would be if I can depreciate something for 5 years, I should buy it with a 5-year term loan.
Got it. Okay.
Right? So a credit card's kind of short-term, a line of credit short-term, a term loan, right? Like a mortgage, like a vehicle loan is a long-term loan. So the length of the loan should match the life of the asset. That's kind of the banking rule. So, but if you look at EBITDA, right, and I could spend another half hour here on just EBITDA, but if you look at EBITDA times 3, if your EBITDA is $100,000, in general, they'll give you about a max of $300,000 in long-term debt. So that's kind of how they kind of keep control of, or not putting you in too much of a thing, right, or too much of a risk category. The other thing is this ratio called debt service coverage ratio. And I'm just going to give you the answers to the test, but it's EBITDA divided by your debt payments, right? It's 1.25 or higher. And what that means, for every dollar you owe, you have $1.25 or more to pay for it. And EBITDA is the cash flow that they use to determine that.
I like it. This is a cash flow masterclass.
That got nerdy real fast.
Yeah, but this is the stuff we need, Mike. This is what more people need to hear. I've been doing this this is episode 393. I've been in business on my own for the past decade at least. I've never heard these calculations before. I understand you used to be a banker and you used to be on the other side, but why don't more people hear about this is my real question.
I think, banks do a bad job at educating, right?
Damn banks. Come on, banks. What are we doing?
But they're busy, right? They're busy and all that. I mean, education takes time, and it's up to you and I. And I think accountants now and bookkeepers should do more education. It's just that bankers and accountants talk different languages. So I'm trying to connect the two with my new company, Cashflow Mike. And I think if you like spreadsheets and all that type of stuff, you would like the app that I built because it does a lot of this for you. Right, even determines how much you can borrow.
Please tell me more. Come on, you can't just tease that before I let you go.
Yeah, well, I sell my stuff in a membership, right, and the app comes with it. So I used to be a software company that had a little education. Now I'm an education company with software, right? So you buy that, you get the education, you get the video courses, you get live coaching from me, plus the app.
I like it. So tell me this then, because I asked that question. I really do believe it's our personal responsibility to be educated. You can't blame others for ignorance. You can only blame yourself. Who are the people that are in this membership or attracted to it? Is there a typical business size, a length of time in business, number of employees, revenue? Give me the sense of who should really be in this membership.
Yeah, and I mean, my big focus right now is advisors and bookkeepers, but it's business owners, and generally from startup to about, I'm going to say 15 million. And I know that's probably not yours, but it's pre-CFO. But now we're even getting some CFOs or fractional CFOs that are coming downstream because I give a way to communicate with the non-sophisticated CEO, right? The guy that's great at his job, the great run his business, can sell anything, but what he needs is somebody to talk to him about debt and cash flow and those type of things.
I love it. It makes complete sense. I'm seeing fractional CFOs at least coming down even below 7 figures in revenue at some companies, and
Mhm.
I love it, to be honest with you, because there's some glorified bookkeepers that slap the fractional CFO label on it. I'm not talking about
Yep.
that, but I love that business owners are prioritizing financial education and financial literacy. That's the stuff that's going to propel you forward in business. So, Mike, I can't thank you enough for coming here, sharing your wisdom, and hopefully some other people, some listeners nerded out with us, and they take that next step and learn about their business. I'll put it on the screen again, cashflowmike.com. But thanks again for being here.
Hey, you're the best. I appreciate you.
All right, wherever you're watching and listening, go check that out. Go nerd out on some spreadsheets. We'll see you on the next episode of Harmonious at Lunch.
Another episode of Harmonious at Lunch in the books. I hope this episode made you think and you grabbed some actionable ideas to propel your business. Don't forget to like, comment your takeaways, and subscribe wherever you're listening so we can help more entrepreneurs just like you achieve harmony in their life and business. For cutting-edge tools that bring clarity to your people and processes, check out humanoff.com to download our app today. See you next time.